Good morning, children. In Plus 2 Commerce, today we are going to see about lesson 6 money market. Before that, just we can recall what we have seen in the 5th lesson, that is financial market. What is financial market? It is a market for financial instruments like financial claims, assets, and securities are traded. And I think you remember on the basis of maturity of financial claim, the financial markets are classified into two types. One is the money market and the another one is capital market. And today we are going to see about a money market. What is a money market? It is simple. It is a market for short-term financial claims such as treasury bills, commercial papers, and certificate of deposit. See the meaning of money market. It is a market for purely short-term funds. Short-term means within 1 year period. And the examples for the short-term funds are treasury bills, commercial bills, certificate of deposits, and government securities. Now we will see about the objectives of money market. The main important objective of money market is to balance the short-term surplus and deficit of funds. And the second objective is to ensure liquidity of funds. And the third one is providing access and uses to users of short-term money to meet their requirements at a reasonable price. So money supply is balanced with the help of money market. The next is the characteristics of money market. The first one is short-term funds. Already we have seen that money market is meant only for the short-term funds. Otherwise, it is called as a near money market. That is, the securities are easily converted into cash. The second one is maturity period. That is, the maturity period is within 1 year. Next is conversion of cash. It deals only those securities which are easily converted into cash without any loss and also minimum transaction cost. Fourth one is no formal place. Like stock exchanges for capital market, for money market there is no specific place. So it can be taken place through phone. Fifth point, submarkets. It is not a single homogeneous market. It consists of several submarkets. Each deals with a particular type of financing. For example, call money market, acceptance market, bill market. And the sixth point is participants are the role of market. Commercial banks, central bank, non-banking financial companies, discount houses, and acceptance house play a dominant role in the market. The seventh point is highly organized banking system. As you all know that the Indian banking system is a well-structured one and commercial banks act as a nerve center of the whole money market. It is the principal supplier of short-term funds. And also we can say that it acts as a vital link between the central bank and other various segments of money market. The eighth point is existence of secondary market. That is, because of the money market, the secondary market is active. The ninth point is demand and supply of funds. There should be a large or huge supply of short-term funds because of the existence of large domestic and foreign trade. The 10th point is wholesale market. As you all know that the volume of wholesale market is very large because of greater flexibility in the regulatory frameworks, that is rules and regulations. Then there are a lot of chances for introducing new instruments. The 12th point, presence of a central bank. As we all know that the central bank acts as an authority to maintain the money supply through its CRR policy. That is, through its open operations, the central bank absorbs surplus cash during off seasons and provides additional liquidity in the busy seasons. Now, we are going to see about the difference between money market and capital market. Already we have seen about the capital market. I think you remember that. Now, the first difference between the money market and capital market is the duration of funds. In case of money market, the duration is less than 1 year, and in case of capital market, the period is exceeding 1 year. And the second point is supply of funds. The money market supplies funds for working capital requirements, that is for a shorter period. But in capital market, it supplies funds for fixed capital requirements, that is for a long-term requirements. The third difference is deals with instruments, that is the money market deals with commercial bills, bills of exchange, treasury bills, commercial papers, etc. But the capital market deals with shares, debentures and government bonds. The fourth difference is the money value. The value of money market instruments are large. That is, in case of treasury bills, the minimum amount is rupees 1 lakh, and in case of certificate of deposit or commercial paper, minimum of rupees 25 lakhs. But in case of capital market, the instrument value is very less. That is, in case of share, it is rupees 10, and in case of debenture, it is rupees 100. The next difference is the role of major institutions. In case of money market, the central bank and commercial banks play a major role, but in case of capital market, development banks and insurance companies play a dominant role. The next difference is the level of risk. In case of money market, the credit risk and market risk is very low, but in case of capital market, it is very high. And in case of liquidity, in money market instruments, liquidity is high, that is easily converted into cash. But in case of capital market, liquidity is very low. Now we will see about the participants of money market, that is who are all participating in the money market. The number one is different countries' government, different countries' central banks, private and public banks, mutual fund institutions, insurance companies, non-banking financial institutions, RBI and SBI, commercial banks, state governments, and public.